This is Wallet Brief, where we break down what actually moved the U.S. economy this week, without the noise. If prices, interest rates, jobs, housing, or taxes are quietly changing your money, this is where you stay informed. Let's get into what really happened this week, and what it means for your wallet. Artificial intelligence just caused real estate services stocks to crash 12 to 14% in a single day. A startup called Smart Bricks raised $5 million to build AI agents that automate real estate investing. And while the industry panics over automation, multifamily investment volume hit $165 billion in 2025, showing investment property markets remain strong despite disruption fears. Jones Lang and plunged as investors' AI could replace human brokers and analysts. AI refers to autonomous systems that carry out multi-step tasks and adapt to changing context with minimal human prompting. These aren't search tools. They're digital teammates that can research properties, deals, and execute transactions. Smart Bricks AI over 1 million data feeds to rank real estate assets by risk-adjusted return, surfacing only the top 0.1% of opportunities. The startup automates valuation, underwriting, due diligence, and even negotiation. What used to require armies of analysts now happens automatically. Meanwhile, investment property fundamentals stayed strong. Apartment cap rates averaged 5.7% in 2025, the tightest among all major property types. Dallas, Miami, Houston, Tampa, and Nashville remain top markets driven by population growth and affordability. Investment property mortgage rates run about 7.5% or higher, roughly 0.5% to 1% above primary home rates. The AI scare trade is targeting any industry where value comes from information asymmetry or manual bipartisan policy. Real estate brokerage built its business on exclusive data and human relationships. AI is the data and automating the analysis. The high-fee middleman model is dying. But real estate as an asset class isn't dying. Multifamily rental households hit record highs. Single-family rental sector rose 1.7% in 2025. Investors are focusing on fundamentals, location quality, income durability, and long-term demand. The disruption is in how deals get done, not whether they get done. If you're buying investment property, AI tools can now help you deals faster and cheaper than hiring traditional. But mortgage rates around 7.5% mean financing costs are high. Cap rates at 5.7% show returns are compressed. Your rental income needs to exceed your mortgage payment for cash flow to work. If you own or similar stocks, Wednesday's crash marked the biggest drop since the 2020 COVID sell-off. The market is pricing in permanent disruption. Consider whether these companies can adapt or if AI will crush margins permanently. And if you're a real estate agent or broker, the agents who aggressively adopt AI tools will have a competitive advantage that compounds. Learn to use automation or risk becoming obsolete. Commercial real estate firms face a data readiness problem. Most are stuck in pilot mode, while competitors' AI. Watch which companies actually deploy AI at scale versus which stay stuck experimenting. Watch secondary markets like Nashville and Dallas. They offer affordable housing and strong job markets, making them resilient to disruption. And watch mortgage rates. Any drop below 7% could reignite investment property demand. That's your wallet brief for this week. These changes don't always make headlines, but they do change how much you pay, save, and earn. We'll be back next week with the updates that matter. Until then, stay informed and protect your wallet.